Welcome to the deep dive. You know how sometimes the market narrative just, well, clicks into place?
Mm-hmm.
Well, today, we're plunging right into the Forex market, specifically the U.S. session for July 2, 2025, to decode exactly what's clicking. We've sifted through a mountain of fresh intelligence articles, research, our own notes to give you the clearest picture of what's really driving currency movements.
Yeah, what's actually going on underneath.
Exactly, and what to watch in the next 24 hours. Our mission is to unearth those surprising facts and deliver those aha moments that, help you feel truly well-informed.
And it truly is a pivotal moment. I mean, when we look at the high-frequency data, central bank communications, all the news flow, well, a very distinct narrative is emerging.
Okay.
We're going to try and lay out that macroeconomic and market context for you.
And for us, the dominant headline, the overarching story, seems to be this profound, almost accelerating weakness in the U.S. dollar.
Definitely the main theme right now.
So when we say profound U.S. dollar weakness, that's a pretty strong statement. For you, our listener, what are the clearest signals, the most undeniable signs that this isn't just a fleeting dip, but maybe something much more significant we should be paying attention to?
Well, look at the U.S. dollar index, the DXY. That measures the dollar against 6 major currencies.
Right. The main benchmark.
Exactly. And it's trading near multi-year lows. We're talking the 96.50 to 96.90 range specifically.
Wow.
And get this, the dollar just wrapped up its worst first-half performance since 1973.
73, that's significant.
It really is, losing roughly 10% of its value against major currencies just since the start of 2025. So this isn't just one thing hitting it, it's a powerful convergence of negative drivers.
Okay, a 10% loss is staggering. Let's unpack those drivers. What are the main forces converging here? What's creating this kind of pressure on the greenback?
Well, first, you've got the whole trade policy situation. It's not just the headlines, but the uncertainty itself.
The ambiguity.
Yeah. When you have threats of tariffs on the EU, or that looming July 9 deadline for global trade deals, well, that kind of ambiguity makes investors nervous. Capital tends to look for clearer waters,
Makes sense.
Then you layer on top of that the growing fiscal concerns, questions about the sustainability of U.S. public debt. That's more of a structural issue, maybe, but it weighs on long-term confidence.
A slow burn, kind of.
Exactly. But the most potent, the most immediate driver right now, it's the market aggressively pricing in an imminent monetary easing cycle by the Federal Reserve.
Okay, so rate cuts.
Big time. Investors are increasingly assuming the Fed will start cutting interest rates as early as September. And not just a little cut. They're expecting a total of 75 basis points of easing by the end of the year.
75 basis points. That's aggressive.
Very aggressive. And this outlook, it's been cemented, really solidified by recent data, like that weaker than expected ISM manufacturing PMI reading below 50 at 49.0.
Which indicates contraction.
Right. And then, frankly, that shocking negative ADP employment change report. These aren't just numbers, they're strong signals of economic deceleration. And that just fuels those rate cut expectations even more.
And as the dollar's struggling under that weight, the plot thickens when you look at how other major central banks are playing their cards.
Yeah.
This policy divergence, it feels like a massive lever in the Forex market right now.
Yeah.
How are the big players responding differently?
Oh, absolutely. This divergence is precisely the primary mechanism through which U.S. dollar weakness is being expressed in the market.
Okay.
So you've got the Federal Reserve. Despite what the market thinks is coming, they're officially on a hawkish hold. They're keeping their target rate at 4.25% to 4.50%.
Holding steady.
Officially, yes. It's their cautious stance, a sort of precautionary measure against inflation sticking around. But the market, as we know, is always looking ahead.
Forward looking, yeah.
It's practically ignoring the current stance and fully focused on those future rate cuts.
Okay, so the Fed's on hold but expected to cut. What about Europe?
Stark contrast. The European Central Bank, the ECB, has already acted. They cut by 25 basis points back in June. That brought their key deposit rate down to 2.00%.
Right, they moved already.
And that was the 8th cut in a year-long easing cycle, clearly aimed at supporting the Eurozone economy.
And Japan, the BOJ.
They're taking a very different path again. A cautious hold is the best way to describe it, keeping their policy rate at 0.5% and moving very, very gradually.
Patient.
Extremely patient. And this cautious stance, combined with the Japanese yen's traditional safe haven status, well, it positions the yen as a primary beneficiary. It benefits from broad USD weakness and any drop in global risk sentiment.
Interesting. So the market's pricing in Fed cuts, largely driven by that softer economic data we mentioned. Which brings us to what's arguably the biggest data point for the next 24 hours, U.S. labor market data. Why is the NFP report so pivotal right now?
It's the absolute pivotal data point, no question. And its importance is hugely amplified by that surprise we got from the ADP employment change report.
The negative print.
Exactly. It printed at minus 33K. Expectations were for a gain somewhere around 90K to 99K. That's a massive miss.
Huge miss.
And that profound miss materially increases the downside risk for the NFP figure itself, which is forecast around 110K. So this NFP data, it really has the potential to either validate the whole market narrative weakening economy, Fed cuts coming, or trigger a substantial reversal if it somehow comes in unexpectedly strong. It's a real make-or-break number this month.
And it's not just the economic reports pointing this way. We're also seeing some pretty telling institutional positioning, right?
Yeah.
The smart money seems to confirm this underlying trend of dollar weakness.
Absolutely. That's a great point. The latest Commitment of Traders report, the COT report, for the week ending June 24th, it provides powerful confirmation.
What's it showing?
Traders were effectively net short the U.S. dollar by $21 billion.
21 billion short. Wow.
Yeah, that's a 5-year high in bearish bets against the greenback. Think about that. The institutional players, the large speculators, are overwhelmingly betting against the dollar.
That's a strong signal.
It is, and specifically, they increased their net long exposure to the euro. And for the first time since last October, they flipped to a net long position on the New Zealand dollar. This kind of institutional alignment against the U.S. dollar provides a very strong quantitative tailwind. It suggests this isn't just, noise. It's a real trend with backing.
Okay, so we've established this powerful undercurrent of dollar weakness, the central bank divergence, and this massive looming NFP report.
Yeah.
Now, let's see how that narrative truly comes alive, or maybe gets challenged, when we zoom in on specific currency pairs, the ones most sensitive to these forces.
Right.
We've handpicked 5 pairs that really stand out based on volatility, liquidity, maybe some unusual sentiment readings, or just significant news chatter around them. These are the ones with the highest potential for fireworks.
Yeah, this selection gives us a good cross-section, a diversified yet focused portfolio to really assess the market's reaction, however it unfolds, to that pivotal NFP data. It's where the rubber meets the road, so to speak.
All right, first on our radar, year USD. This pair feels like the poster child for the whole anti-dollar trade right now, doesn't it?
It really does. It's the primary focal point.
It's in a strong, bullish trend, clearly. But for those of you who follow technicals, the Daily Relative Strength Index, the RSI, is pushing above 70.
Overbought territory.
Which confirms the momentum, yes, but it also screams overbought. How do we reconcile this strong rally with that kind of technical signal?
That's the key question. Well, the current interest rate differential, Fed at 4.50% versus the ECB down at 2.00% nominally favors the dollar.
On paper, yeah.
On paper. But the Forex market is always forward-looking. The rally we're seeing isn't about today's rates. It's driven entirely by the expected future differential. The market is aggressively pricing in those Fed rate cuts we talked about. That effectively neutralizes the dollar's current yield advantage in the eyes of traders.
Okay, so the market's looking past the current rates. Now, this is often where the real surprises lie, the sentiment picture. What are we seeing in terms of retail versus institutional positioning here? Is it shaping up as one of those classic contrarian plays?
Precisely. It's a textbook example right now. Our data shows a striking 67% of retail client accounts are positioned short on URUSD.
67% short, so they're trying to sell into this rally.
Exactly. They're fighting the trend. And in sentiment analysis, that retail crowd positioning is often a powerful contrarian indicator.
Fade the crowd, as they say.
Right. The fact that such a strong majority of retail traders are on the wrong side, well, it suggests a large pool of stop-loss orders, which are effectively buy orders, exists just above the current market price.
Potential fuel for more upside.
Could be. If those stops get triggered, it could act like rocket fuel for further gains. Now, our AI simulations, they project a high probability that the pair will stay above the 1.1700 level over the next 24 hours. But, and this is important, they also highlight a fat tail risk, a non-trivial chance of a sharp decline back towards 1.1650 if that NFP number comes in surprisingly strong. So while the bias is clearly bullish, we have to respect that NFP wildcard.
Got it. So bringing all those threads together, the fundamentals favoring euro strength due to Fed expectations, the institutional longs via COT, the strong contrarian retail short signal, what's the core outlook for USD?
The bias is definitely bullish. It's driven by that strong convergence of fundamental quantitative COT and sentiment factors. The potential price zone we're looking at for the next 24 hours is roughly 1.17 DES to 1.1870.
And confidence level.
Our confidence score here is a solid 7 out of 10. It's only tempered by that technical overextension, the RSI being high, and the binary make-or-break nature of the NFP release itself.
Okay, 7 and 10, bullish on euro-dollar.
Yeah.
Next up, GBP-USD or cable.
Well,
Exhibiting pretty similar dynamics, highly correlated with USD. Right?
very much so. It's also trading at multi-year highs. It's broken through some key long-term resistance levels and is trading above its 200-week simple moving average, which is significant technically.
And the sentiment picture. Similar to euro.
Almost identical, actually. It features a strong contrarian retail short position as well. 68% of retail accounts are short cable.
Wow, even slightly higher.
Yeah, so that acts as a powerful bullish signal, just like in EURUSD. Plus, there's a bit of seasonality at play. July has historically been quite a bullish month for GBP-USD, with an average return of plus 0.45% going back to 1971.
That's interesting historical context, so sounds quite bullish overall, but are there any red flags, any notes of caution we should be aware of with the pound specifically?
Yes, a couple of things just to keep in mind. We are seeing a slight bearish divergence in the COT report for sterling. Unlike the euro, large speculators actually reduced their net long exposure to the pound recently. It's subtle, but it's a counter signal to the retail sentiment.
Okay, institutions pulling back a bit.
A little bit. And also, domestically in the UK, unemployment ticked higher recently, up to 4.6%. So while the overall outlook remains bullish, largely following the dollar weakness theme, cable is perhaps a little more vulnerable to a sharp correction if a strong US dollar catalyst emerges from that NFP data.
Right, maybe slightly less conviction than euro-dollar then.
Exactly. The primary bias is still bullish, but maybe tentatively so. We see a potential price zone of 1.3650 to 1.3850. The confidence score reflects that slight vulnerability, 6 out of 10, slightly lower than USD because of that COT divergence and the domestic UK data point.
Okay, 610 bullish on cable. Let's move to USD-JPY. You called this the purest vehicle for expressing a view on U.S. rates and risk sentiment.
I think it is, yeah. Technically, the picture here is unequivocally bearish. It's trading below its key moving averages. Importantly, it's completed a classic head and shoulders topping pattern.
Pointing lower.
Yeah, technically pointing towards further declines, maybe down towards the 141.70 area.
And the rate differential, I mean, U.S. rates are way higher than Japan's 0.5%, aren't they?
Nominally, yes. The differential is massive, 4.25, 4.50% versus 0.5%. But again, the market's intense focus on impending Fed cuts is compressing the forward yield spreads.
Ah, the expected future difference again.
Exactly. That compression removes the primary pillar of support that USD-JPY has relied on for a long time. And the institutional positioning. The COT report shows it's firmly bearish on USD-JPY. Large speculators are heavily net long JPY futures. They are betting big on yen strength against the dollar.
So technical's bearish. Rate expectations shifting against the dollar. Institutions positioned for yen strength. How does broader risk sentiment play into this?
It's highly sensitive. USD-JPY often acts as a barometer for global risk appetite. The prevailing theme right now, potential U.S. economic slowdown, persistent trade uncertainty that provides a consistent bid for the yen as a safe haven asset.
So a weak NFP could really hurt this pair.
Absolutely. A weak NFP report would likely be seen as a significant risk-off signal. That would probably accelerate the decline in USD-JPY. Our AI simulations. They project a high probability of the pair testing that 142.00 to 142.50 support zone in the next 24 hours. That would be a pretty significant move lower from here.
That sounds like a very high conviction forecast, especially with so many factors aligning. Technicals, fundamentals, quantitative sentiment.
It is. It's our highest conviction call today. The primary bias is strongly bearish. We see a potential price zone of 142.000 down to potentially 144.0 if there's some volatility, but the focus is lower.
And the confidence score.
It's an 8 out of 10. That's the highest so far. It's driven by that really strong, consistent signal across all the analytical models we use. The path of least resistance just looks clearly lower for USD-JPY right now. The main risk, the counter signal, would be a massive NFP beat that completely resets Fed expectations, but honestly, all the current data points firmly against that scenario.
Okay, 810 bearish on dollar-yen. Now, this next one raises an important question. What happens when technical momentum and fundamentals really clash? AUD-USD, the Aussie dollar. It's in a strongly bullish short-term trend, hitting fresh yearly highs. Looks strong on the chart.
It does.
But the underlying fundamentals for Australia itself seem pretty bearish, right? With a dovish Reserve Bank of Australia, the RBA, and another rate cut widely expected from them in July.
This is exactly where the major conflict in the analysis arises. It's a real puzzle. The pair's current strength seems almost entirely a function of that broad-based US dollar weakness we've been talking about. Plus, generally positive risk sentiment lately. It doesn't seem to be driven by strong Australian domestic fundamentals.
So it's riding the anti-dollar wave mostly.
Pretty much. And critically, look at the COT data again. It reveals that large speculators are actually increasing their net short exposure to the Australian dollar.
So institutions are betting against this rally.
Yes. They're actively fading this move higher. That's a significant red flag for anyone looking to jump on the bullish bandwagon here.
So it's like a real tug-of-war. Price action screaming bullish, but the smart money via COT and the domestic fundamentals are shouting bearish. That sounds like a recipe for a highly unstable, unpredictable market.
Exactly. It suggests things could snap back pretty quickly. Retail sentiment, interestingly, is fairly neutral here, maybe slightly long, but not extreme, so it doesn't give us a strong contrarian signal either way. And historically, July has been a modestly bearish month for AUD/USD anyway.
So what do the AI models make of this conflicted picture?
They reflect the conflict perfectly. The simulations produce a very wide probability distribution, no clear peak. It really reflects this deep disagreement between the different layers of analysis. They suggest maybe a higher probability of just consolidation, chopping around 0.6550, with any decisive breakout highly contingent on that NFP report. This one really feels like a coin flip, depending on that data.
Okay, definitely a pair where extra caution is warranted. The NFT could swing it wildly either way.
For sure. So our primary bias here is kind of sideways to maybe tentatively bullish, just respecting the recent momentum. The potential price down looks like 0.6500 to 0.6620, but our confidence score, it's only 4 out of 10. That's because of the direct and significant contradiction between the technical picture and the fundamental quantitative signals. It's the least certain in the bunch we're looking at.
410 sideways, tentatively bullish on Aussie dollar.
You got it.
Finally, let's look at KDJPY. You flagged this one as a potential high volatility tinderbox.
Yes, this one is coiled. It's sitting at a critical technical inflection point. Looks like it's getting ready for a major breakout, which makes it probably the highest volatility potential candidate for this session. Long term, you see some analysts targeting levels as high as 115, even 130 someday.
Well, way up there.
Way up there. But short term, right now, it's actually showing some signs of a potential bearish breakout.
Okay, so fundamentals, which way are they leaning short term?
Short term, the fundamental backdrop currently seems to favor a bearish resolution. The Canadian dollar, the loonie, is under a bit of pressure from retreating crude oil prices. Plus, the Bank of Canada has sounded a little more dovish lately.
Okay, CAD weakness.
And meanwhile, the Japanese yen is gaining strength from that safe haven status we discussed amid all the global growth and trade uncertainty. So the fundamental winds seem to be blowing towards yen's strength against the Canadian dollar right now.
Now, this is where it gets absolutely fascinating, you said. The sentiment picture for CAD/JPY is arguably the most compelling, the most one-sided of all the pairs we're looking at today. What are we seeing there?
It's really staggering. Data from CMC Markets, for example, shows that a whopping 83% of their retail clients are positioned long on TJJPY.
83% long. That's huge. That's almost a textbook example of the pain trade, isn't it?
It really is.
It's like the retail crowd is practically painting a target on their backs. Inviting the institutional players to hunt those stop losses below the market.
That's exactly the dynamic. This extremely heavy retail long positioning is a powerful bearish contrarian signal. It creates, just as you said, a massive pool of stop-loss orders, which are sell orders sitting just below the market, particularly under that key 105-100 level.
Liquidity pool.
Precisely. And institutional traders are often incentivized to push price towards such liquidity pools. So as you said, this pair really does feel like a tinderbox just waiting for the NFP data to provide the spark.
Given that kind of explosive setup, that extreme sentiment, what do the AI simulations suggest for this tinderbox of a pair?
Well, fittingly, the AI models for SAJPY show what's called a bimodal distribution, like two humps.
Two main possibilities.
Exactly. High probabilities clustered around two very different outcomes. Either a sharp rally, maybe towards 106.50 and beyond, if we get a strong risk-on signal, like a surprisingly strong NFP. Or a steep and rapid decline, potentially towards 104.00, on a risk-off signal like the weak NFP that many expect. It truly underscores its explosive binary potential. It's almost a go big or go home scenario for this pair, depending on the news.
So what's our primary lean for this truly high potential, high volatility pair? Where do we land?
Given the weight of the evidence, particularly that extreme sentiment, the primary bias is bearish, but with very high breakout potential, likely outside the recent range. We're looking at a potential zone of 104.5 to 106.00, acknowledging it could easily break below or above that.
And confidence. How do we score that?
It's a bit nuanced. Our confidence score in the specific direction being bearish is a solid 7 out of 10. That's based mainly on that overwhelming contrarian sentiment signal and the developing bearish momentum. But our confidence in a volatile, high-magnitude move in either direction, frankly, is very high. Let's call that 9 out of 10. This one seems primed to move and move significantly.
Okay, 7-10 bearish directional bias, but 9-10 confidence in a big move for KDJPY. Fascinating setup. So it's abundantly clear, listening to all this, that the NFP data is the linchpin. It's the single piece of information that could truly shift everything we've just discussed across all these bears.
Absolutely. It's the main event risk.
Let's pull back then and look at the full consolidated picture now.
Right. If we distill all this analysis, maybe think of it like an executive summary table.
Yeah.
Well, USDJPY clearly stands out. It has the highest conviction for a bearish move, simply because of that strong alignment across all the analytical layers, technicals, fundamentals, quantitative, sentiment. They're all pointing the same way.
Okay. So for you, our listener, trying to navigate these complex markets, how does all this multi-layered analysis, looking at fundamentals, technicals, sentiment, everything, how does that translate into something, well, actionable? Can you maybe walk us through an illustrative example? How might someone approach a trade given these insights?
Sure. And let me stress, this is purely illustrative, okay? This is not financial advice.
Understood. Just an example of the thought process.
Exactly. So let's take USDJPY, given that strong bearish bias and the high 810 confidence score. A possible strategy based on this analysis might involve looking to enter a short position, but perhaps not chasing it lower right away. Maybe waiting for a corrective rally, a little bounce up to a pre-identified resistance level, an area where we think institutions might be looking to sell.
Okay, selling strength in a downtrend.
Kind of, anticipating a subsequent move lower towards those key support levels we identified. So, for instance, again, purely illustrative, an entry price might be targeted around 143.9.
Okay.
The take profit target might be set down at 142.40, which is just above that 142.00, 142.50 zone we talked about, near the bottom of the potential range.
And the stop loss, risk management.
Crucial. The stop loss might be placed, say, at 144.60. That would be above the recent highs and that potential 144.000 resistance level.
So what kind of risk reward does that setup offer?
In that specific illustrative example, it would yield a risk-reward ratio of about 2.11 to 1, which is generally considered pretty strong. So that's just one way this kind of multi-layered analysis helps define potentially high probability scenarios and structure a trade plan. It helps you approach the market with a clearer, more informed strategy rather than just guessing.
That makes sense. Seeing how the different pieces fit together to build that conviction. What a deep dive this has been. We've really peeled back the layers on this profound U.S. dollar weakness, seeing how those central bank policies are diverging so significantly, and pinpointed just how critical this upcoming non-farm payrolls report is for all these major currency pairs, USD, GBP/USD, USD/JPY, all DUSD, and that volatile KDJPY.
And understanding these multi-layered dynamics, I think that's the key takeaway. Looking at the technicals, the fundamentals, the quantitative data like COT, the cyclical pattern, sentiment, even bringing in AI-driven insights. It's essential. It allows you to see not just what is happening in the market,
But why it's happening.
Exactly why it matters and what patterns start to emerge when you connect those seemingly disparate data points.
Right. So to wrap up, let's leave you with a provocative thought to consider. Just how deeply intertwined are these global economies and central bank policies? And how can one single piece of data, like this NFP report, send such powerful ripples through the entire system, creating both significant risks but also potential opportunities right across the globe? What really stands out to you in all this?
Good question to ponder.
We hope this deep dive leaves you feeling well-informed, maybe seeing the connections a bit clearer and ready to explore further. We certainly look forward to our next deep dive with you.